Here's the strange part about technology stocks right now. Earnings are still strong. The AI investment cycle is still moving forward, and analysts are still expecting substantial profit growth. But the valuation math underneath many technology stocks is getting harder. The reason is not simply that the Federal Reserve has not cut rates fast enough. The more important signal is the 10-year real yield. On July 16th, the nominal 10-year Treasury yield stood at 4.57%. The 10-year real yield was 2.35%. And the difference between them, the market's 10-year inflation expectation, was roughly 2.22%. Back in March, the 10-year real yield averaged around 1.91%. By June, that monthly average had risen to 2.18%. So this is not one noisy trading day. The real cost of long-term capital has been moving higher for several months. And that creates a very specific problem for expensive technology stocks. They now have to produce more growth just to justify the same valuation. That is the signal we're examining today. This is macro market signals. Most investors watch prices. Here, we track the signals behind them. What a real yield actually tells us? Let's make this simple. A nominal Treasury yield tells you how much a government bond pays before inflation. A real yield tells you how much return investors are demanding after accounting for expected inflation. A simple way to think about it is nominal yield minus expected inflation equals the real yield. But the real yield measure we're using does not come from subtracting the latest CPI report from the 10-year Treasury yield. It comes directly from the market for Treasury inflation-protected securities, or TIPS. That distinction matters. CPI tells us what inflation has already done. The TIPS market tells us the real return investors are demanding from long-term capital right now. And that real return acts like a hurdle rate for almost every other asset. When investors can earn a higher inflation-adjusted return from government debt, they become less willing to pay an extreme price for profits that may not arrive for another 5, 7, or 10 years. That is why real yields matter so much to growth stocks. And growth stocks and technology stocks are not exactly the same thing. But many high-valuation technology companies trade like long-duration growth assets because so much of their valuation depends on earnings expected far into the future. The further away those profits are, the more sensitive their present value becomes to interest rates. The price of time is going up. Suppose a company is expected to generate $100 in cash 10 years from now. At an 8% discount rate, that future $100 is worth roughly $46 today. Raise the discount rate to 9% and it is worth only about $42. Nothing changed about the company. The expected cash flow is still $100. The product did not get worse. Revenue did not disappear. Management did not lower guidance. But the present value fell by almost 9% simply because investors raised the return they require for waiting. That is the key idea. Higher real yields raise the price of time. And when the price of time goes up, distant earnings become less valuable today. This is why a company can report good results while its stock still struggles. The business and the stock are being judged by two different tests. The business is judged by revenue, margins, and earnings. The stock is judged by those results and the price investors are willing to pay for them. Imagine a technology company growing earnings by 15%. That sounds positive. But suppose the market previously valued it at 35 times earnings. Then real yields rise. The risk-free alternative becomes more attractive, and investors decide they will only pay 28 times earnings. The company improved. The valuation environment deteriorated. Both can happen at the same time. This is where investors often get trapped. They see a strong company and assume the stock must also be attractive at any price. But those are different questions. The question is not simply, are earnings growing? The real question is, are earnings growing fast enough to outrun the contraction in the valuation multiple? Sometimes they are, sometimes they are not. And that is the contest taking place underneath technology stocks right now. The first signal is already clear. The first signal is the real yield trend. The 10-year real yield averaged 1.91% in March, 1.94% in April, 2.04% in May, and 2.18% in June. The latest complete daily reading is 2.35%. That is a meaningful change in the valuation environment. But this does not mean technology stocks must immediately collapse. The S&P 500 Value Total Return Index is up approximately 1.8%. Value has now moved slightly ahead, roughly 9.97% versus 9.32% for growth. And in the latest session reflected in the index data, growth fell 1.43%, compared with a decline of only 0.51% for value. 1 month is not enough, but it does tell us that the stock market is beginning to acknowledge the pressure that the bond market has been showing for months. Investors are becoming a little less willing to pay for distant expectations. They are placing slightly more value on earnings and cash flow that already exist. That is exactly the relative shift we would expect to monitor when real yields remain elevated. But earnings are still fighting back. Here is why this is not a simple bearish call. The earnings picture is still strong. As of July 17th, only about 10% of S&P 500 companies had reported second quarter results, so it is still early. But 88% of those companies had beaten earnings estimates. So we currently have two forces pulling in opposite directions. Real yields are raising the valuation hurdle, but corporate earnings are still helping companies clear that hurdle. That is why the correct conclusion is not real yields are high, so technology stocks must crash. The better conclusion is technology stocks now need stronger earnings simply to defend the valuations they already have. That is a much more demanding environment. When real yields were falling, a company could receive help from two directions. Earnings could rise, and the valuation multiple could expand. Now, companies may need earnings growth just to offset multiple compression. The third signal decides whether this gets worse. The most important confirmation will come from earnings revisions. Right now, earnings are still providing support. But imagine what happens if three things begin moving together. Real yields stay high or move higher, growth stocks continue underperforming value, and analysts begin cutting forward earnings estimates for major technology companies. At that point, technology stocks would lose both supports at the same time. Investors would be willing to pay a lower multiple, and the earnings base supporting that multiple would also be weakening. That is when a valuation problem can turn into a broader market problem. The market would no longer be dealing with expensive stocks attached to strong businesses. It would be dealing with expensive stocks whose expected growth is being revised down. Why a Fed cut is not automatically bullish. This is also why the sentence, "The Fed will cut rates so technology stocks will go higher," is incomplete. Technology stocks do not simply need the federal funds rate to fall. They need the real cost of long-term capital to decline. And the reason for that decline matters. Suppose the nominal 10-year yield falls by 20 basis points. That sounds supportive, but suppose inflation expectations fall by 30 basis points at the same time. The real yield has actually risen by 10 basis points. The headline rate went down, but the inflation-adjusted rate became more restrictive. There is another problem. Real yields can fall for two very different reasons. The first is the good version. Inflation cools, economic growth remains stable, and the bond market becomes more comfortable with the outlook. That can support technology valuations. The second is the bad version. The economy weakens sharply, investors expect a recession, and real yields fall because something is breaking. That may help valuation multiples, but it can also damage revenue and earnings. So growth stocks do not just need rates to fall. They need rates to fall for the right reason. What would prove this concern wrong? A serious market thesis needs a clear invalidation point. Here is what would weaken the concern about real yields. First, the 10-year real yield begins a sustained decline. Not 1 or 2 days, but a real trend. Second, growth stocks regain relative strength against value. Third, technology sector earnings estimates continue rising fast enough to absorb the higher cost of capital. If those three things happen together, the market would be telling us that earnings growth is still stronger than the valuation pressure. In that case, elevated real yields would remain a headwind, but they would not be controlling the trade. What would confirm the warning? The warning becomes more serious if the opposite happens. The 10-year real yield stays near current levels or moves higher. Growth continues losing ground to value, and earnings revisions for high-valuation technology companies begin to roll over. That combination would tell us the bond market pressure is no longer theoretical. It would be showing up in relative stock performance and in the fundamental outlook. Until then, this is not a confirmed technology breakdown. It is a rising hurdle, and the market has only just started showing signs that the hurdle matters. The market spends a lot of time debating the next Federal Reserve meeting. But for technology valuations, the more useful question is, what real return is the bond market demanding from long-term capital? Right now, that return is significantly higher than it was a few months ago. Technology earnings are still strong. That is the main reason the sector has been able to resist the pressure. But growth stocks are beginning to lose some relative momentum, and value has moved slightly ahead for the year. So the message is not that technology must fall. The message is that the valuation environment has changed. Strong earnings used to create upside. Now, some of that growth may be needed simply to defend the current price. Remember the central idea. Real yields are the gravity beneath growth stock valuations. And growth stocks do not just need rates to fall. They need the cost of real capital to fall for the right reason. That leads directly to the next question. What is the one rate signal that would tell us the environment is actually becoming supportive for growth again? That is what we will examine in the next episode. Last but not least, if you enjoyed this breakdown, do hit that like button and subscribe. Data reveals the truth and logic guides the way. I'll see you in the next one.